if you had these 5 stocks and just 20% in each of these stocks, you would have made 30.1% per year essentially. This is possible.
You're listening to the Visionary Investor Podcast.
I'm your host, Andrew Marks, and I'm a stock market wealth investment mentor, speaker, and entrepreneur who has a passion for all things stock market investing, diving deep into quantitative and qualitative analysis, creating formulas and calculations that optimize stock market investing, and creating a life that fits your biggest and wildest dreams. You're in the right place if you're ready to tap into some investing strategies that aren't taught without getting a degree, working for an investment firm, and some that aren't even taught anywhere else in the world. Find deeper clarity on your investments and what your future can hold. Strengthen your understanding of recession, stocks, and your money, and learn the tools to accelerate your investments and wealth. You're here to be a visionary investor, not an average one. A passionate disruptor with uncommon goals in the investing world. It doesn't matter where you are in your investing journey. You're never too late to become a successful investor, and I'm here to help you do that. Let's get into the investing flow. Let's take a look a little bit further into the details behind an index fund to see what may be missing with it. In the stock market, when we're thinking of an index fund, it's like a basket of securities such as stocks. Now, with an index fund, what people like so much about it is it does make it easy for generally an investor to invest because they're able to buy multiple securities or multiple stocks with one investment. But if we look at the ticker symbol VOO, this is the Vanguard 500 index fund, which essentially tracks the S&P 500. And with that, it's a way to purchase 500 companies essentially with one investment, one purchase through this index fund. Now, that may sound great off the bat, and many people do think that's great, but let's talk a little bit further about the returns and what those look like. If we look at the past 5 years, the total return for VOO was 51.3%. Now, if we annualize that, which essentially gives us an average per year, over each of the 5 years, it would have averaged to about 8.63%. If we compare this to something like creating your own stock portfolio, imagine this. You invest into just 5 companies. They're in different sectors. I'm going to walk you through it right now. Apple in the information technology sector. Microsoft also in the information technology sector. Eli Lilly in the healthcare sector. Deere & Company in the industrial sector, and Lululemon in the consumer discretionary sector. So there's 5 companies, and we have 4 different sectors essentially that are represented here. Now, to keep things simple, let's say you just invested 20% into each of these 5 stocks. If you held them for the past 5 years, your total return would have been about 273%. Now, if we annualize this again so we can kind of compare apples to apples, this would mean you averaged about 30.1% return per year. Now, what would you rather? Would you rather make 8.6% or 30.1%? See, investing into the S&P 500 is a way that you can get an average return. But when you're looking to get a much better than average return, a lot of people are concerned that you're taking a lot more risk and that it's really hard to find good stocks. I just showed you 5 stocks. I want to conceptualize this a little bit further. If you invested $1,000 into this index fund VOO, you would have about $1,500 after 5 years. If you invested $1,000 into your own stock portfolio, after the same 5 years, you would have about $3,700. Now, what if you invested $10,000 into VOO, the index fund? You'd have $15,100. If you invested that same $10,000 into your own stock portfolio, you would have about $37,300. Now, this is a drastic difference. What's happening here? This is the power of compound interest. And I know we've talked a little bit about it on other podcasts, but your annual return is so critical to helping you make more money and essentially to double your money a lot faster. You could use something called the rule of 72. If you take 72 and divide it by your interest rate or your annual rate of return, this will tell you how many years that you'll be able to double your money in. So for instance, if we take 72 and we divide it by 8.63, this shows that it's going to take about 8.3 years to double our money. Now, if we take 72 and we divide it by 30.1, this shows it's going to take 2.4 years to double your money. Is a 30.1% return per year an excellent return? absolutely. But I'm showing you how this is possible. It's possible to completely beat the market. It's possible to do so having less risk than you think. The problem is most people are not talking about this and teaching you how to do it. But I just showed you 5 stocks, and these 5 stocks are in the S&P 500. They are large cap stocks. All of these are well above $10 billion. Obviously, Apple and Microsoft are $1 trillion market cap companies. Eli Lilly, about $400 billion. Deere & Company, about $113 billion. The smallest one is Lululemon at almost a $50 billion market cap. By increasing your annualized return above average, essentially to beat the market, you're allowing yourself to reach your goals that much faster. And you don't have to take on a lot more risk to do this like most people think. So the great thing about investing into the stock market is if you take the matters into your own hands and you actually take control of your own portfolio, you can beat the market. Of course, there are risks associated with this, and you always want to do your own due diligence and do your own research. But I'm showing you here, this is the past 5 years. So if you had these 5 stocks and just 20% in each of these stocks, you would have made 30.1% per year, essentially. This is possible. And I'm here to show you what's possible, because so many people will just tell you, go invest into the S&P 500. Go invest into an index fund, an ETF. But is that really fitting for your goals? And maybe you want to make more than an average return. I don't blame you, because I want to make more than an average return too. It is totally possible for you to do it, and I'm here to help you get into that mindset, help you see how it's possible, and share with you a sample portfolio that would have done it. Thanks for listening, and don't forget to subscribe to the podcast, leave us a kind review, and follow us on all other platforms at The Visionary Investor. Have a great day.